Raven is absent. Wood?
Here.
Reeser?
Here.
Pollitt?
Present.
Loftus?
Here.
A quorum is present.
Thank you. There is a consent agenda. If you would like to approve the consent agenda, I'll take a motion. Seconded. It's been moved and seconded that we approve the consent agenda.
Wood?
Aye.
Reeser?
Aye.
Pollitt?
Aye.
Loftus?
Aye.
Thank you. Motion carries. Business, our first item today would be a report from CIBC Investments.
Welcome, Bruce. Thank you, everybody.
Thanks for making the trip, Bruce.
Of course, I'm glad to see everybody. I want to start by introducing my colleague who, I'm told that we can see him, but he can't see us. Is that right? Thank you. Yeah, that's what I hear as well. So, Matt, we see you. Just by way of intro, since Matt just flashed up on the screen, what I've been trying to do is every annual meeting bring something different to the table to maybe give you guys a deeper dive on aspects of what goes on beneath the hood of the portfolio. So you might remember last year, Dave Donadian joined us, and Dave was our chief investment officer, now is our co-chief investment officer. And he sort of oversees the team. And this year, I've asked Matt Shear to join, and he'll speak towards the end of the presentation. But Matt is one of the two co-portfolio managers of our international equity strategy, international growth strategy. And international being extremely topical. I don't know to what degree all of you follow what's going on in the financial press, but that's been the winning place to be this year. And obviously, with some of what's going on out of Washington, international has become a hot topic, and you have a significant investment there. So I thought you might enjoy hearing a few words from Matt, which we'll get to. In terms of the presentation itself, Pat, should I limit my comments to 10, 15 minutes? Is that about?
I think so.
Okay. And then I've asked Matt to speak for about 10 minutes. Will that math work?
We can make that work.
Okay. In the book that I believe you all have a hard copy of the presentation, great. The first section I really won't go over because many of you have known us for a long time. To the degree that there were some people who were a little bit newer, I just thought I'd give a quick section of rehashing CIBC. And again, I won't really dwell on it, but just to remind you, we manage about $110 billion. We're spread throughout the country, and to the point of Matt again, we have an investment team that's over 70 people dedicated to looking at every stock, every bond, every fund, every day. And again, Matt is just one example of 70 plus people in that role. Getting maybe right to the meat of things, I'll take you to section 2. And I thought I'd just start before we get into the specifics of Blackwell, just giving a very brief overview of what is going on in the world, what happened last year, and again, Matt will delve on the international side. But in this print that's probably a little too small, you'll see last year, this is just a series of indexes obviously, and you'll see that the S&P 500 was up about 17 and change %. But what I want to highlight is if you follow down to the third highlighted item, it says S&P 500 equal weight, 11.4%. And I'll tell you what that means in a minute. And then the S&P 500 3-year at the top, almost 23%. And again, that equal weight, about 12. So I think that's one of the broad themes to be aware of. Again, as many of you might know, the S&P 500, which a lot of people look at as a market benchmark, has become increasingly dominated by, they call it the Magnificent Seven, 7 tech stocks, Amazon, Apple, etc. And it is to an unprecedented level where 10 stocks in an index index that's 500 stocks, 10 now represent 40% of what's going on in terms of the performance of that index. It's truly unprecedented. So the reason we look at the equal weight is, as fiduciaries, we don't want to put 40% of your money in 7 or 8 stocks. It would be pretty imprudent. So looking at an equal weight is to say, what if I put $1 in every stock in the S&P 500 and had a low risk profile? And as you can see, over 3 years, it's half the return. So we just think that's a relevant thing to point out. And then you've got a chart on page 8 that drives that home. Last year, if you put your money in just the 7 big tech stocks, Apple, Amazon, et cetera, 25%. If you put $1 in every stock in the S&P, 11.5%. And then you can see the similar numbers for 24, 23 in the last 5 years. So it just drives home this theme of market concentration, and we're keeping even more well diversified than that. As a result, this year were our stocks up as much as the S&P 500? No, but you're broadly way more diversified. The S&P 500 has become a kind of a high-tech bet on 7 to 10 companies. So it's kind of both fascinating and a lot to wrestle with. And then similarly, if you go to the next page, you see a chart. It says U.S. equity is a two-pronged headwind for active management. And this makes a similar point, is that what traditionally drives performance and hopefully outperformance of active managers is buying what we call quality companies, companies with low debt on their balance sheets, growing earnings, et cetera, et cetera. This chart basically is showing you that what's driven the recent returns in the market is low quality companies, companies that either don't have solid earnings or so-called, you might have heard this term meme stocks that people are sort of trading for fun, have actually outperformed stocks that are growing earnings. So it's been a bit of a headwind for active managers. And then I think page 10 again really drives home this point of market concentration. On the far right, you see the 10 largest companies in the S&P 500, and on the left you see it says 40%. So these 10 companies made up 40% of the S&P 500. I think it's fascinating to go back and look at the decades, 10 years ago, 20 years ago, et cetera. So 10 years ago, only 4 of the now 10 stocks were the same in terms of the largest companies in the S&P 500. 20 years ago, it was 1. So you've had this just seismic shift, and to me, it's a cautionary tale that everybody only today wants to own these 10 stocks. Well, if you look at history, that hasn't worked out so well. Putting all your eggs in the basket of what worked now over the next 10 years commonly hasn't worked out well. So that's kind of an interesting chart. And then the last big picture chart I'll show just to, again, talk about thematically what's been going on is page 11. AI, artificial intelligence, the world is asking, is this a bubble? We're in the camp of saying, no, things are expensive, but is it a bubble? No, because the big difference of what's happening now and what happened back when we had the sort of dot-com and telecom market meltdown was the companies that have outperformed, that are dominating this sort of AI bubble, if you want to call it that, are real companies with real earnings, and that was not the case in the last meltdown. So that's what this chart is showing, just that it's expensive, it's a time to be cautious, it's a time to diversify, but do we think it's a bubble ready to crack? No, but spread out thinner over the ice and be a little more diversified, and things like international debt, now we'll talk about, we think that's appropriate. I'll go on to the performance of Blackwell, but any questions just on that brief background before I do? All right, so if you go, now we'll get to what I think is the meat, which is section 3, the actual performance of the portfolio. So if you look at page 12, you will see on, well, I'll start at the upper left. The portfolio ended the year 51.3 million, and you can see in the green donut you've got 32% fixed income and cash, 68% equity. On the bottom section there, it gives you the dollar history, and I'll show you percentages in a moment. So the portfolio started the year at 50,042,000 and change. You can see your net withdrawals about 3.2 million. You can then see income earned of about 1.2, as well as price growth of about 3.3. And as a result, when you do that math, you're about 51.3. So more than where the portfolio started, which is obviously the goal. And then I like to look at the 3-year and the 5-year in that same fashion. You can see that over 3 years, if you were to add the income and the market appreciation, you get about 17 million, and you took out about 8.7 million. So again, you know, in terms of what I think has been the long-term goal of the public trust, we are not only preserving capital even after distribution, but growing the principal to keep up with inflation. I think in the last 3 years, to more than keep up with inflation. 5 years, not quite as robust, only because 2022 was a difficult year. But you get the idea. And what I think is maybe, in the spirit, the most interesting statistic of all is if you look at the since inception to date, you can see you've made about 14.5 million in income, about 36 million, a little bit more in price growth. When you add those together, it's 51.3 million. It's actually just slightly more than the entire portfolio right now is worth. So what that's telling you is you have everything that's in the portfolio now is profit, if you will. So even though it's 50 million bucks, you've sort of taken out, if you will, all of the original money, but you've got more money, but it's all gains. The gains in income are exactly equal to, almost exactly equal to what you've all made over the years. So I thought that was a fun statistic. Page 13. What does this mean in terms of rates of return? You can see for the year, the total portfolio was up 9.27%. It gives you the breakdown. Your fixed income portfolio was up 7.2, which I'll say is the best fixed income return we've had in many, many years. Interest rates are finally reasonable again, and bonds are finally a real asset class again. And then your equities were up 11.3%, and that's how you get to the 9.27. Again, you've got the 3-year, the 5-year. I'd highlight again, the 3-year is 12.63, with stocks being about 17.5%. So again, stocks, of course, have been driving the boat. And then I think, given the very long tenor of the portfolio, September 2010 inception date, I think it's important to look at the inception to date rate of return, which is over 8%. And you know, at 8% rates of return, I hope we could do that for you guys the next decade. But there's an investment rule that basically, as a generalization, tells you at 7% you double your money every 10 years, and so at 8% you're going to more than double your money every 10 years. It's been a great long-term return. You know, we'll see if the next decade is anything like this one, but that's a nice long rate of return. Questions on that? Okay. Page 14 just gives the last few years of history of that return. So we already saw the 9.27 on the right. Just shows you that last year, 12.7, year before 16, et cetera, in case you wanted just a quick rehash of how these average returns have come about over the last few years. Page 15 is just a little more granular breakdown of your asset allocation. We already said fixed income was 32%. In your case, it's 100% taxable bonds if you own other types of instruments that would break it out here, but of course you don't. You're a diversified, high-quality taxable bond portfolio. And then among your equities, you've got the 68% that we referenced. This will show you that you've got about 30% in large cap, and U.S. large cap, I should say, and that is our equity income portfolio, so that's a dividend-focused portfolio, traditionally lower what we call downside risk than the S&P 500. So the S&P 500 is down 10. This historically has been down something like 9 7% in a dedicated small cap portfolio. And then lastly, certainly not least, especially with now on the phone, almost 15% in international. And I'll just point out that 15% international, when you divide it by your 68% stocks, so it's about 21 or 22% of your stocks. So it's a pretty meaningful chunk of your equity portfolio. Flipping to the next page. Again, this is maybe information overload. It just breaks down. You have several different accounts at Charles Schwab, so this just breaks down what each of those individual accounts has earned. It all aggregates up to the same 9.27 that we discussed. But you can see, for example, I'll just go to international, up almost 27% last year, and that's to my comment that international was definitely the star last year. The next page just shows the annual, or not annual, this past year's withdrawal rates, just to give you a pictorial of that. And basically that's the returns of last year. I'll pause for any questions. Okay. Well, if you go to section 4, we just thought, since we're in February, even though we're presenting on 2025, we give you a snapshot of how's 2026 so far. So this just gives you January. We did this last year as well. And you can see that so far so good. Again, we started at 51.3. Here's your withdrawal, 213,000. 85,000 in change in income. 561,000 in price growth. So keeping that same theme, albeit for only a month. Portfolio is continuing to grow. Now approaching 52 million. And then page 19, just again the percentage rate of return. So that was 1.26 last year, with fixed income just nudging up a bit, and equities driving that return at 1.75%. Page 5, or sorry, section 5, is the portfolio valuation section. So we've broken it down by the various strategies that you're in. The first one is the intermediate bond strategy. Not a lot to say. You're in only per mandate of your investment policy statement. You have no junk bonds. You have only investment grade securities, high quality corporate bonds. You have about half the portfolio is corporate bonds. The first section you see, followed by U.S. Treasuries are about 34%, and then lastly you have some mortgage-backed securities, which are U.S. government agency guaranteed, about 16%. So roughly half government bonds, including the mortgages, and half corporate bonds, all high quality, and again up over 7% last year. So that's doing its thing to stabilize the portfolio. If you go to page 26, now we're looking at the equity income portfolio. And again, this is, as I mentioned, and it says it on the bullet points, it's a dividend growth strategy. It's outperformed what we call the Dividend Aristocrats Index over time. Dividend Aristocrats just looks at companies that have raised dividends annually every year for 25 years, at least 25 years. And that's a dividend index that a lot of people look at, and we've outperformed that, not every year. And then you've got the schematic here to sort of show, again, we strive to not be an index fund. So you can see many years when we would outperform, some years when the Dividend Aristocrat outperformed, but on average, since the inception of this strategy, it's outperformed that Dividend Aristocrat strategy by about 2% per year. And that's your largest equity allocation. If you then go to page 27, even though it did fine last year compared to the Dividend Aristocrats, again, did it keep up with the S&P? No, because when NVIDIA is a massive percentage of the S&P 500 and dividend strategy can't buy a non-dividend stock, which is NVIDIA, then it's by definition going to underperform. But you can see here, whenever dividend stocks typically have underperformed, they're kind of getting set up for a period of outperformance, which is our belief. And you can see we've actually just now had the worst 2-year period for dividend stocks since the notorious tech bubble of 1998, 1999. So again, strategy's making money, not as much as the S&P. Our belief is that that ship's about to turn. And then you've got the next several pages just details the individual companies that you own. Again, because this is a dividend strategy, you might be interested to look at the last column on the right, which is the annual income. So it really highlights in aggregate what each of these companies pays. And then on page 30, just this basket alone of dividend stocks, you get an aggregate of about $372,000 of pure income. And I would say that's understated because, again, it's a dividend growth strategy. So if there's a company in here, well, we don't want to own a company that is not going to increase that amount for you every single year. So that amount should actually go up. Moving on to the all-cap growth. On page 31, again, it's an all-cap strategy, so it's large but also small and medium. Small and medium have been good recently, not as good over the last few years, when the market was dominated by these big tech stocks. But again, you've got a schematic that just sort of shows, going back to 2015 and since inception, when has this all-cap strategy beaten all the various indexes and when has it lagged. And last year it did lag. It did better than, it was kind of marginally better, in line with the small cap index, a little bit worse than the mid cap. It did lag the large cap, again, because of this market concentration, and it's an all cap index, it's not a large cap index. Then again, page 32 just gives you the, again, list of holdings. You'll notice very few dividends on this page to differentiate it from the equity income strategy we talked about. And then international growth is the last section, and this is the section that, again, Matt, who's on the screen, who I know can't see us, is one of the 2 portfolio managers, so I really thought this would be a good time to maybe have you meet another member of the team and have Matt opine. So I'm going to turn it over to Matt, but first, any questions about anything else that I talked about?
No, thank you.
Okay. All right. Well, Matt, you are up then, and everybody in the last section, you have some slides that relate to what Matt's going to discuss.
Yeah. Hey, Bruce, can you hear me all right? Because the line is a little garbled on my side. Can you hear me okay?
We hear you totally fine.
Oh, good. Okay. Well, if you need to jump in and stop me, jump in, or if there's a question, jump in. But thank you so much for having me. Yeah, my name is Matt Scher. I've been with the firm for 16 years. I actually started as an energy analyst, so spent a ton of time in Oklahoma and Texas. And fun fact, I actually once presented to this group many years ago, probably almost a decade ago, probably it felt like. But so I really am happy to be back here, and I think my background as an energy analyst really informs everything. I'm a huge believer that energy markets are key to growth, they're key to inflation, they're key to geopolitical risk, and some of the things that are going on in our country with the growth of energy and now being the largest producer in the world, and I think some of the things this administration has done with respect to working with OPEC have, I think, been very positive and will continue to lead to positive outcomes. Somewhat frustrating maybe for those producers that, because of oil and gas prices are maybe not as high as you would like, but for the country and economics in general, it's quite good. And if we look at page 39, I think, all year long I've had, been speaking with clients and had people tell me, well, what about oil? What about Iran? What about China? What about tariffs? All these things that people worry about, and yet the stock markets, as Bruce has outlined, continue to march higher and higher, especially international markets. And I think that, as investors, we need to really look through some of these geopolitical risks. We need to understand these risks and really translate into how they impact the companies that we invest in. And if we can find great businesses that are generating strong cash flows, this element of geopolitical risk can be in the background, and we can continue to grow capital. I think that if you look at the next page on page 40, we get a lot of questions about, well, Matt, why do I even need international? The U.S. stock market, which is in green here, has been phenomenal for the last 15 years. There's no reason to own international. International has actually outperformed, and it's true. And I would say there's 4 reasons why international has outperformed the U.S. And number one, I think over the last decade, since the shale revolution, that's been a huge positive for our country. Number 2, people criticize the Federal Reserve, but the reality is that relative to the European Central Bank or Bank of Japan, I think our central bank has done a great job. Number 3, our country, this is good or bad, but we've spent a lot of money. Our budget deficit is rising, which maybe long term is not great, but near term, that puts a lot of money into the U.S. system. That's been good for the U.S. Well, now the Europeans and the Japanese are following that. And the final piece is technology. The U.S. has the best technology sector in the world. That's never going to change. So when we think about, the U.S. doing so well in international sort of having a bit of a lag, but now starting to catch up, things are changing. And the 2 big things that are changing is Europeans taking the U.S. playbook. They're deregulating, they're spending more money, and this is going to be really positive for their economies. Now, I am a believer that you should always have some international. On the next page, we call that the structural reasons, and then after that, I'll talk about why I think international is even improving from here. So why should we always have international? And I know Bruce has done an awesome job of sort of having you guys in international for periods just like last year, where we start to get really great performance. And the reason why you should always have some international is that it's a huge world out there. We all sort of are sitting here in the U.S. and we've had a great economy and we've had a great stock market, but we have to remember that the U.S. today is less than 1/4 of the overall global GDP, and it's shrinking. China is taking share, Europe is stabilizing, Japan is stabilizing, and the rest of the world, which is Brazil and Indonesia and India and all these places we don't think about that often, are growing really fast. And so that's where we need to be allocating more of your money, or at least having some exposure, because there's all these great places to be investing around the world. It's also for what we call diversification. We want to sort of have the zigs and the zags. When the U.S. is going up, international might not be doing great, but then international picks up and the U.S. might slow down. And we have to remember that the diversification benefits of investing abroad are massive. What this chart is trying to show you on 42 is that NVIDIA, which we all hear about so much, the size of NVIDIA alone is bigger than the whole stock market in England. It's bigger than the whole stock market in France. And it's like, it's almost 3 times as big as the whole Australian stock market. So by just having some international exposure, you get so much diversification, meaning you're exposed to different sectors, different economic cycles, and that really will help your portfolio smooth out returns over time. So what are the cyclical reasons on page 58 and then going right to, page 43? What are the cyclical reasons, meaning why international now? Why is it starting to work now? And on page 43, I would point you to this long-term chart that goes back to 1975, the year I was born, but really could go back, I could take this chart back to 1950 and show you the exact same thing, which is that there are cycles. There are periods of time where international works, US works, international works, US works. And you can see that whenever the purple bars are up high, that's when international is doing well. When purple bars are low, that's when US is doing well. And you can see this has been an epic period. The purple bars have been down for a long time, meaning the US has done great for a long time. But you can see that over history, it's been back and forth. And we think that we're probably starting a period where international starts to do a bit better. On page 44, the way that you can visualize this again is to say, okay, which stock markets are the biggest? And the dark blue is the US. And you can see last year that the US is almost 70% of global markets. It's the biggest stock market. But if you went back to the 80s and the 90s, the US was only 30%. And places like Japan, the UK, Europe were much bigger parts of the market. And you can see how the blue has been, it's been as high as 60, it dipped down to 30, and now it's 70. So this is just another way to show that over time there are cycles. And maybe we're entering another cycle where international does better, which is why we have it in the portfolio. On the next page, 45, it was a little jumbled, but I think I heard Bruce reference AI, which is such a hot topic. And one thing about international markets is we don't have as many big tech companies, which is why it's good to have the US piece and the international, sort of the yin and the yang. And while we don't have a lot of the Google and the Microsoft and the NVIDIAs of the world, I think there's something even more important about AI that will benefit international. What this chart shows is that AI is all about productivity. And it's about, basically making all the workers do more with less. We don't think it's about putting everybody out of a job. We don't think that's gonna happen. What we really think is gonna happen is that we'll all use these AI tools to do more. And on page 46, this is a little bit of a joke, but it's kind of serious, which is if you say, if we have this new tool which makes you most productive, who will benefit the most? That person that is least productive will benefit the most. And we all know in Europe, the number of hours worked per person in France and Germany, it's pretty low. The productivity out of Europe is not great. And so if AI tools make everyone more productive, there is a case to be made that in 5 years we'll look back and say, holy cow, Europe is now actually growing at a decent rate. And it's because they were not productive, and with new tools they can become more productive. And so this is another reason why we think it's important to have international. On page 47, there's also a bunch of areas that are really interesting right now, whether it's robotics. We hear about how new factories are popping up around the world. They're all automated. Those machines are largely made in Japan. If we think about luxury goods, people around the world are wanting to buy fancy stuff. They want stuff from Europe, Louis Vuitton, these fancy watches like Richemont. And so, we think that's an area that you can only access in international markets. Rare earth metals, we hear so much about rare earth metals, and China dominates rare earth metals. But some other countries like Australia also have big exposures of rare earth metals. So getting that exposure outside of China is really, really important, and that's what we're trying to do. So we think there's a lot of really great themes abroad that you can only get abroad that you can't really get investing in the US. On page 48, this is really probably the most important slide, which is, we've all heard so much about NATO and defense and the war in Ukraine, and I think President Trump has done a really great job of sort of highlighting the fact that whether it's defense or healthcare or some other areas, Europe has maybe not pulled their weight. And I think the message has been sent and the message has been received. And we've seen a new government in Germany come in and say, look, we need to spend more on defense. We need to spend more on infrastructure. We're seeing the same thing across Europe. We're seeing the same thing in the UK. And what this means is that they are going to start to borrow more money to invest in defense. They will likely have to pay a little bit more for healthcare, meaning a lot of times drugs are developed in the US and maybe in Europe they don't have the same price point that we have. And they will start paying more. They will start investing more in healthcare. And so as they invest more in these areas, it's going to help their economy because it will create more jobs. It'll create more spending. And so we're really big believers that we're on the front end of a big spending spree in Europe, led by defense, followed by infrastructure, and then third, healthcare. And that's going to be really positive for international investing. We're seeing the same thing in Japan. New government in Japan, they just had an election 2 weeks ago, just had a real big mandate to spend more money. On page 49, you see in Germany, it's already starting to have a positive impact where you're seeing more money being spent by companies. That's going to all lead to better stock market performance. On page 50, I would just summarize. If I look around the world, why are we excited about international? In places like Australia and Canada, it's about commodities. It's about gold, it's about rare earth metals. It's less about energy and more about copper, things like that. In Mexico and India, it's about friendshoring, meaning we need to move manufacturing out of China. Some of it's coming back to America, but the reality is that most of it's going to Mexico and India, places that are more friendly to America, and so we can invest in those themes. In Europe, there's more spending happening, defense, infrastructure, like I mentioned, very good. In the UK, they're deregulating, meaning they're looking at the US and they're saying, why are we successful? One of the reasons is that we have less regulation. They're taking that playbook and implementing it so that they can be more successful. And even in China, we're starting to get a little more positive on China in very specific areas like technology is where we've invested a bit in China. So on page 51, my last slide would be, over the last year, every single meeting I go into, people ask me about the thing on the left. inflation, hiring, politics, debt, energy, terrorism, China. People are worried, I get it. But you have to remember, for every negative, there's a positive. It's the concept of the bell curve. Everything on the left is a left tail risk, but all the stuff on the right is the right tail risk. There's lots of great things going on. We're gonna have lower taxes here in the US. We're gonna have more fiscal spending around the world. We think the war in Ukraine can end, which would be really positive. We think OPEC is managing oil prices well right now. They're doing a good job. Defense spending, AI, wage inflation is good. So I just think there's a lot of really good things going on around the world, including in America. And I think these are the reasons why international did well last year. These are the reasons why we think it continues to do well. And these are the reasons why we think it's a really important part of your investment profile. So hopefully you can hear me all right, Bruce. It's a little hard to hear, but if there was any questions, I'd be happy to take them.
Yeah, we hear you fine. Anybody, questions, anybody?
I have a question, if you don't mind.
Yeah, sure.
On the international stage, and you talked about, you made a reference to OPEC a while ago. I think about 30% of the nation's oil comes out of the Persian Gulf. And I know we're worried about what's going on in Iran. Can you hear me a little better there? If the Straits of Hormuz were to be shut down and 30% of the world's oil was hamstrung right there, in your opinion, what effect would that have on the global market?
Yeah. Bruce, I'm gonna repeat this, and if I'm way off, let me know. But I think the question is if the Straits of Hormuz were closed, what does that have on global oil markets and the economy? Is that right?
Absolutely.
Correct, yes.
Okay. Yeah. So I think a couple things. I think first of all, I think that much like we've seen many times before, I think this is a negotiating tactic by President Trump. He's moving assets, which are aircraft carriers, into the region to give us credibility at the negotiating table. And I think that this is going to end in a resolved negotiation. Why? Because in a midterm year where cost of living is so important, and President Trump has done so much work so far to keep oil prices low in the form of encouraging U.S. production, as well as working with Saudi Arabia to keep OPEC on sides, meaning OPEC is producing more oil right now than they should be. And in my opinion, it's because the administration has done a lot of work to get them to be sort of in line with us right now. And so I think having done all that work, the administration realizes is we can't have a war in the Middle East and shoot prices up because it'll be so negative for cost of living. So my first answer is I think it's going to be a negotiation tactic and it's going to result in that. The second answer is that let's say it does result in war. I think it's harder than people think to shut down the Straits of Hormuz. But even if it happens, it clearly would be a negative shock. My opinion is it would be short term. Couple reasons. I think that the U.S. has become the swing producer. I think that, that shale, right now what we've seen is that U.S. shale producers have been sort of 65 and above, they're hedging, and then they're producing in the Permian Basin. And I think if we get a massive spike, what we'll see is a bunch of shale producers hedging into that spike and producing, and it'll be 6 months or less before we start to see U.S. oil production really ramp up. And I think that is the biggest change we've had in the last decade. The reason why we didn't go send a bunch of troops during the Israeli issue, the reason why we didn't send a bunch of troops to Ukraine is because we have become the swing producer, in my opinion. And it will result in a short-term shock if something like that happened, but I think it would be short-term, and I do not think it would derail the global economy. And that's maybe a more optimistic approach. There's many who think that it could lead to $100 oil again. I'm not so sure that would be the outcome.
Thank you.
Thank you, Matt. Any other questions?
I just had a quick comment. I looked at, just looking at page 12 when you talked about the market appreciation, the earned income. I think that I just want to say thank you to your company and the city council that put this in place. What a blessing to our community when you think about the money that we started with, the money that we spent, and the money that we still have today. And I just want to say thank you for handling our money and doing it well.
Thank you, Dave.
And I echo
obviously means a lot, means the world, and I was gonna say the same. Thank you for your continued confidence and trust in CIPC and for letting us be part of the journey. And I should dig it out. When we originally were sort of crafting this arrangement, we had done, Mike, you might remember, but we had done a sort of a financial plan where we said, hey, in order to meet our goals, originally 3% a year, now 5%, which I know I believe will lessen back to 3% at some point. What rate of return do we have to earn? And I can't remember what we modeled, but it was less than 8%. So,
Yeah, it was
was it 6?
Yeah.
Yeah, okay. Yeah, so,
We sit there go.
Yeah.
If we got 3 going in to account for inflation, and we pull this, we'll have growth in what we can pull, and we will have an increasing amount of principal to work with over time. And that is exactly what has happened to this deal.
yep,
And, you know, you guys and BANCFIRST both have performed admirably on this thing, and we're just doing exactly, we've been very, very careful not to overspend, and to allow you guys to follow the investment policies and do your thing, and, you know, we're careful as a board about how we spend, and we continue to let this grow
right.
a little bit all the time. You know, what we can take out of it is also going to grow.
Yeah, well, again, so thank you to everybody for saying that. It really does mean the world, and appreciate the confidence. And, yeah, we'll keep making the moves that we have to make within the investment policy statement to keep it going. And I guess I also want to add, I love when Matt presents this. I think his passion shows. But again, there's 70 more or so Matts, all of whom has equal passion, and all of whom looks at every dollar in the portfolio that we manage for you as passionately as Matt does and as fiduciaries. So we appreciate the partnership.
Thank you.
Thank you. Thank you, everybody. Thank you, Matt.
Thanks, everybody.
Thank you.
Welcome, BANCFIRST.
Hello.
Hello.
Well, thank you again for having us, and I don't see any faces, so we kind of know the drill. I show up and let you know, we really do appreciate our relationship with you guys, and we love working with you. If you have any questions during the year or need any additional information, please feel free to reach out. Tracy is great to work with as well. So as usual, I'll hand off to Steve here pretty quickly. Thank you again.
All right, well, thanks. I'll be relatively brief and give a good overview of everything. I'm happy to answer any questions. A lot of what I'll cover will echo what you heard from the other manager. We have a lot of similarities, some key differences, and so I'll point some of those out as we go as well. But if you'll turn really very briefly on the first tab, the market summary, a lot of this was covered in the prior, so I won't belabor it, but would like to note that, and this is through the end of January, on the left-hand side, you can see the market from the bond market to the stock market. Everything has been really positive, just different degrees of positive. The bond market's been extremely strong. We participated with that. It's great to see, but it's also really nice to see what's happening in equities. And one of the things that's important for us in the way we invest money is diversification is really paying off for us. Diversification is something that's always been a period where we've been rewarded for being diversified and different in how we invest, and we'll highlight some of that as we get into the details. But if you'll go to the next tab, historical return summary, this is the real high-level summary that I like to prepare for this account, just to give us our history. You can see that it goes back to inception all the way to 2010, rolling forward all the various years. If you go to the bottom, right before the dark line, you can see the beginning balance of $5,537,000 rolls over to the ending value of $5,959,000 roughly. And then the rates of return for the entire portfolio for the year. There's the year proper 2025, 15.4% gross fee or 14.7% net of fee. So we had a really good year. It was, again, a really nice time to be diversified. A volatile year, as I'm sure most of you follow the news and follow the markets and watch some of the highs and the lows and all the motions in the market. But we weathered it pretty well. Since inception, our return is right below that, 8.5% per year gross of fees. So we're real happy with our returns and what they've been able to do, weathering obviously a number of storms last year, but also a lot of market storms over the past 15 years or so. If you'll go to the next tab, the asset allocation, we can highlight how the account's invested. We are adhering to the 60-40 long-term target, actually have about 57.3% in stocks or equities. You can see in the pie chart at the left-hand side. The remainder is going to be in fixed income and cash equivalents. The total balance as of the other day, so you can notice in the upper right-hand corner, this is as of February 18th, $6,168,000. So you can see we've had a really nice January and February so far. So a lot of growth since the numbers that we were looking at on the prior page. Noting how we're not exactly at 60-40, we continue to have an underweight to stocks and an overweight to bonds. That in particular is an area where diversification is working. It's just not something that's necessarily pleasant. If we had a time machine, we'd rather would have had everything in stocks. Stocks had such a great year. But bonds had a really good year too, and it's important to think about risk-adjusted returns. So I'm real happy with our returns and what we've been able to do, despite the fact that we had a conservative stance that actually detracted from where we could have been had we been 60-40. But again, it's important to always balance risk against those returns. In the equity breakdown, in the next pie chart, you can see how we're invested in all the subclasses. As we'll talk about in just a second, we have some similar thoughts, maybe even stronger thoughts on how diversification is important in equities right now. About 25% of what we have is in the green section and the next two blue sections, representing our large U.S. stock exposure. And the remainder is going to be in mid-size and small-size companies in the U.S. in purple, and then the two red sections that are going to be our international holdings. This is pretty consistent. I don't think we've made any changes since we met last, even a year ago, much less when we met in the mid-year period. So been pretty consistent with this allocation and expect to be relatively pretty consistent going forward. Expect the same reasoning to support it going forward. In the bond area on the next page, so you're a little bit greater than 40% invested in bonds. It's going to be comprised of intermediate term and a little bit of shorter term U.S. bonds right now. No international bonds in the portfolio. While we do have international bonds as part of our long-term strategic outlook, we don't feel the need to have international exposure right now. So just U.S. bonds in the portfolio. And then the list of the various managers that we use in each of those different slices of pie is on the next page, page 5. Let me get to the performance review. If you go to the next tab and actually go to page 8. A few things to point out here. So this is through, look at the top of the page, this is actually through January. So we're reporting our January numbers on this page. I'll show you what the breakdown of the year 2025 was in a second. But in if you look to the middle left of the page, the year-to-date, which would just be the month of January, the investment gain was $161,000, or 2.7%, so a very good month of January for us. Last 12 months ending in January, $865,000 of investment gain, which is net of fees, 15.3%. Notably, that's not just a good number to have. It's anytime you can get 15%, I'm going to be happy. And sometimes the market's higher, sometimes the market's lower. The market was actually lower. The class blended benchmark right above that was only, I say only, 12.5%. So we were able to grow considerably more than that benchmark, even though we have a similar, if not a little bit better risk profile than the benchmark does. And that translates both into the bond area and the stock area. If you look at the blue line down below, for the 12 months ending in January, 7.2% growth in the bond portfolio. So a very, very nice number in bonds and beat its index of 6.4%. And then on the next page, the equity numbers are going to be very similar. For the last 12 months, we're up 22.5% in equities, beating the S&P 500's 16.3% through the end of January. And before I go to the 2025 numbers, if you'll turn back to the prior page on page 8, and very similar to what the other manager was able to report, if you look at the graph in the top right, you can see that's going to chart the origin of the account, and looking at the red line, that's the original amount invested with BANCFIRST, adjusted for contributions and withdrawals. And you can see the notable periods of withdrawal and the trend in withdrawals over time. And notice that the red line goes below the zero line on the y-axis. So the fact that it's negative means we pulled out more money from the account than you originally put in because of growth in the market. The blue bar is the value of the account. So even with having pulled out more money than you ever put in, we still have a balance that's a little above $6 million. So it just speaks to the long-term nature and the plan that you guys outlined originally and our ability to live up to that. You can see the details of those numbers in that report period, which is the since inception data, starting with 4.4 million and ending with 6,091,000. Down below is at 8.5 and 7.8% since inception annualized rate of return we mentioned before. Thinking about 2025 specifically, if you go to page 10, this is the calendar year returns. So for the calendar year ending in December, the portfolio was at 15.4% gross of fee, or 14.7% net of fee, again beating the benchmark's 13.6%. And that outperformance came both in bonds and stocks. So in bonds, we were up 7.6% for the year, and in stocks, we were up 20.9% as compared to 7 and 17.9 for the two benchmarks, respectively. Let me stop here, and before I get to a little bit of our market outlook and discussion, to see if there's any questions, any other details I can provide on how we've been invested or the portfolio returns. Okay. Well, a lot of what we think is really echoing what the other manager believes and a lot of people in this industry believe, just to different degrees. So I won't really go through as much in the way of details as I normally would, since you've kind of heard some of it before. But I'd like to highlight some areas of agreement and then some areas that we're a little bit distinct. If you'll go to page 23, I believe we reported this chart last time, and this is definitely something, or at least a piece of this was mentioned by the other manager. This is an analysis of the S&P 500, and this is looking at price to sales ratio and just how expensive the S&P 500 is. And as the other manager mentioned, down below in the bottom half of this page is a discussion of how concentrated it is. So the same figure that they were pointing to, about 40, as of the end of the year, about 40%, 40.7% of the S&P 500 is 10 stocks. We've been concerned about that for a long time. We think that's problematic. One way to put it, have you ever been to a party? Imagine if you go to a regular party every Friday night, and it's a really good party, and everyone starts going to it, and it's really fun, and it just, week after week, it's a great party. And then you start to think, well, could there be another party that would be maybe as good as this one? It starts to stagnate. It starts to concern you that it's not going to be as fun anymore. And you hear rumors of these other parties where there's better music and better food. Well, we think there's other parties out there than the S&P 500. And we've been looking for those other opportunities, and we're really finding them in some other places, notably in small cap stocks. So if you'll turn the page to the next page, page 24, when we look at valuation, when we compare the U.S. market on the left-hand side, the large stocks in the S&P 500, whether we talk about growth stocks or value stocks, they look very expensive. That party looks very stale. It doesn't look like that party can continue to parties delivered in the past. When we look at the very far right-hand side at small value stocks, their valuation on a price to earnings basis, a long-term earnings basis, is very, very cheap. That looks like a party with a lot of promise to us, if you will. That is something that tells us, as we look back at history, valuations tell the future. They just tell it in long-term sways of the future. They don't give you any real good indication of what you should do tomorrow, or even in a month, or even in a year. Sometimes it comes in a year's time. But over the longer term, they definitely tell you where you should be. And this is guiding our judgment, and has for a while, that small cap value is a very attractive place to invest. And that's been a very attractive place to invest over the last several months already, and it's got a long ways to go. It had a great year. Ending in January, it beat the S&P 500 over the 12-month period. It's kind of a little unheralded. And even with that, its valuation is still near the bottom at $12.50 for a dollar of earnings. Whereas the other indices on the large cap side, with their really good year, they are about as expensive as they get. So that gives us concern. We also have enjoyed international markets. So international markets, particularly the areas we invest in internationally, which tend to be the value components, they were up over 40% last year, which we participated in quite a bit with our international allocation. But that valuation on the next page tells us a similar story when we compare it back to the U.S. So on page 25, all these stocks are large stocks throughout the world, either developed markets on the left or emerging markets on the right. And in both of those cases, and in each of the delineations between growth and value, they're much cheaper than their U.S. counterparts. In the U.S. market, growth stocks are priced at $66.30 for a dollar of earnings from the prior page, 37 and 46, much lower valuations, much more attractive. And the U.S. market in large cap value stocks over 25, 18 and 17, much more attractive internationally. So even though they've had a really good year, we think there's a lot of opportunities still ahead for international markets for a number of reasons. I wouldn't disagree with anything the international analysts had to share, but I would say there's more to it than that even. There's a lot of structural reform that's going on. There's a lot of trade deals that are going on internationally that are really positive for those companies and for those countries. So the opportunities continue to emerge throughout the rest of the world, and it's guiding our investment. Now, back to why we like bonds over stocks in particular areas. That's on the next page. And when we say that, we really like bonds in large U.S. companies more than stocks in large U.S. companies. When we look at investing, we want to know what our rate of return is going to be for a measure of risk. And if we're taking the same amount of risk, we'd rather have more return. If we're taking more risk, we definitely need to have more return. It's compensation for that risk. So as a stock investor, you're taking more risk than as a bond investor. So you should see a higher return. One way to measure that return would be in yield, and that's what this page is showing us at the very top. In blue, it's showing us the yield on the S&P 500 stocks over the last 20 years. And notice that usually we get more yield from the stocks than in green, bonds in the same companies. But that has not been the case for the last couple of years. The yield on stocks and the yield on bonds is really pretty close together. In fact, a lot of that period has seen bond yields higher than stock yields, and that's inflation-adjusted bond yields. So that gives us a lot of reason to shy away from those large U.S. stocks and look at their bonds as an alternative. And that's what's driving that decision to be underweight 5% in equities. And even with that, we've been able to enjoy really, really good returns. So let me stop there with our outlook and see if there's anything else I can address in regards to it, or how we are seeing the future going forward, or what the past has been.
I think we're good.
Well, we appreciate your business and your long-term loyalty.
Thank you very much.
Thank you very much.
Thank you. I don't want to give CIBC all my love, but you guys have done a great job too. Just looking at these numbers, terrific. I think you've done a great job.
Thank you, appreciate that.
Yeah.
Thanks, guys.
Thank you.
Safe travels.
Thank you.
Moving on, we need to recommend reappointment of David Reeser.
Make that motion to recommend the reappointment of David Reese for a 3-year term.
I'll second that motion.
It's been moved and seconded.
Wood,
Aye.
Reeser. Polley,
Aye.
Loftus.
Motion carries. Congratulations. Next, we need to receive a presentation from Chuck Anderson, our street superintendent.
Mayor, if I may, before they get started, I would just like to say a few words to the BPT. Your vision and your concern and dedication, it is a joy to sit here as a Blackwell citizen and see the trust where it sits today. I cannot thank you enough as a citizen that you all take time out of your own lives to care so much about Blackwell, and Blackwell owes you all a debt of gratitude, so thank you very much. As we go into this presentation, your investment that you made 2 years ago into the city of Blackwell, you're going to see how that's paying off. But I also want you to keep in the back of your mind, it's more than the $800,000 a year investment that you've made. I call it the ripple effect. By investing that money into the city, what you've done is you've freed up other monies out of our $1.2 million capital improvement that we can put into parks, that we can put into other things. Obviously, these 3 things we're about to show you are 3 of the most important things to us, but it allows us to take that money that you invest in these 3 different projects and put it into police cars, put it into fire equipment, put it into buildings and stuff. And on behalf of the city, all of us, we can't thank you enough for that investment, and we are so overjoyed to sit here today and show you the results of your investment. So, as we go through this, as you see, it's dilapidated houses, streets, and water lines. I'll talk on the dilapidated structures. Cindy could not be here due to an emergency. But Lauren, if you'll go ahead and just kind of click through the houses. We've torn down, you can go ahead and click through the PowerPoint. We've torn down 44 houses to date. Actually, there's 7 more that have been approved, that have already went out to be bid, that have already been bidded, and will be torn down in the next couple weeks. And that's it's more than pretty substantial. That's a huge, huge investment to Blackwell. 44 dilapidated structures already torn down. Here are some examples. You can just kind of click through those. Obviously, we didn't put them all on there, but these were some of the worst ones we had torn down up to this date. Now, let's get on to what serves the entire community, and this is what I love about these next 2 projects. Not only does it benefit, if there was a dilapidated structure torn down by my house, yeah, I love it, but, you know, somebody that lives on the north side of town, it doesn't really impact them. But the investment and the strategies we put together with roads and water lines, every citizen in Blackwell, because we attacked the artery streets first, so all of us get a benefit from that. It's not just one side street where 12 people drive down, we all drive down these artery streets. So as we click through this, I'm gonna let Mr. Anderson speak first, and then we'll let Kyle speak, and they'll kind of speak to what they've done.
I just want to echo what Mr. Whelan said, how much we appreciate, the trust authority making these funds available for us to get these projects done. This year marks 33 years that I've been at the city, and for much of that 33 years, we've just been able to do what we had to do to get by because there was no funds available. And so to be able to do some of these projects is a kind of a breath of fresh air to be able to get some stuff done. I spent the first 18 years that I was with the city in the water department, and I can remember for much of that time, Fred Blair was in charge of the C&D at that time, and every year he would put in for money to replace valves. And that would be the first thing that would be cut, you know? And so we would be out there in the wintertime making repairs on water lines and being soaking wet and cold because you couldn't shut it off. So this is truly a blessing for you guys to free up these monies for us to be able to do these projects. If you look up here, you'll see on a lot of these streets, the first thing we'll do is go in there with the asphalt zipper, and we will tear up these streets and work the base. Some of them we don't have to. Some of the brick streets, we can just do an overlay, but some of them that don't have the brick base under them, we have to do a full depth reclamation of the base. And that's what you see going on here on that first picture there. And then some of them we can just do the overlay. And we usually do like a 2-inch overlay on the streets that we do an overlay on. So we're just excited to be able to make some headway. You know, Blackwell didn't get in the position it's in overnight, and it'll take a long time to get it done, but at least we have a starting point, and we're excited about that. This is 6th Street, doing an overlay on 6th Street here. And we kind of made a big deal about finishing up 6th Street there, just because we were excited to be able to get this done, so.
Not only are we lucky to have your investment, but we are super lucky, and Bryce and Russ will also echo this. Chuck and his street department are one of the few street departments that possess the skill, possess the equipment to do this stuff. To have them, if we didn't have them, we'd have to contract this out. And I'll kind of put it in the context for you. When we did the hospital bill where we did 13th Street where Evans did it, I think that was $2.43 million that we paid for that. How much did it cost you to do Blackwell? $200,000. So the monies they save by possessing the skill and the pride to go out and do these jobs is just astronomical. Now we'll let Mr. Day talk. He's our C&D water guy.
And then I also wanted to just touch on the same thing. I appreciate it very much. I work for 2 separate municipalities other than Blackwell, and we've never been able to have any sort of resource like this to do a project of this magnitude and can continue to do multiple streets, so it's extremely amazing. As far as everything up there, that's the amount of different size pipe and that we have replaced going across all the intersections out to Dewey, and then all the valves that we have replaced up to that point. The grand total being the main line, we've been putting about pretty close, almost 2,000 feet of just brand new 6-inch through there. Then that's kind of some pictures right there. That first one is Dewey Street, 2 brand new valves on that 8-inch, and then you see a new tap that moved it up over and headed south to McKinley, which also put in a new fire hydrant with better flow to also help the fire department. And these pictures here are all the brand new 4 fire hydrants we installed at the park off that brand new 6-inch, which will help with a lot of with the fires and all the flow issues they had. We had 2 fire hydrants prior, and both of them were marked as black, no flow at all. And those, I don't think they've been marked yet, but they will have no problem. We're out.
That's my favorite picture right there. That's when they finished the 6th Street project. So can't say enough good things about the people that do these jobs for the city, but also can't thank the trust enough for your investment. We just wanted to take a little time and show you what your investment in the city has been doing. It's astronomical, in my opinion, that we're making so much progress. And like it says up there, thank you, Blackwell Public Trust, for continuing to beautify Blackwell.
I'd like to make one comment. Sometimes it's a little tough to get money out of this group, but I think more than anything, I've seen over the years, instead of just saying, I need money, tell me what it's for. And Jerry and his guys have done that. When we talked about this extra money, what are we going to do with it? I don't think we don't want to micromanage micromanage what you do, but we want an idea of what it's gonna go for. And that was proven on this project 2 years ago, and where we've been in 2 years. I appreciate it. I appreciate the update. I have to go through the same thing with my wife. Whenever I want something, she wants to know what for. And that's all we expect too. And we're very lucky, people have said this all day, to have this money and be able to do this, and we like to do that. It's good that we have Mr. Loftus here to say, we can't spend this much money, and he looks at the financial side of it, but you guys have done a great job. I appreciate that. It's money well spent, and I like what you're doing.
Thank you. I want to echo those statements. It's so nice to take 6th Street again. I've avoided that road for 10 years, and now it's just, it's wonderful. You guys having the talents and the staff and the equipment and the resources. I remember when we redid Coolidge, I wasn't even in administration. And I asked Mark Wardell one day, I said, man, boy, wouldn't it be nice? And he goes, man, that's the goal, is to get these artery streets done. He said, they're just so expensive. And now we've got the equipment, we've got a little bit of money, and we got guys that know what they're doing. And you look, we've got Chrysler, 6th Street, Blackwell, a lot of downtown. I think the stuff that we were thinking about in 2005 to 2010 before we got this money, those dreams are actually becoming a reality now. And I appreciate your all's work so much. It's been amazing, really.
Good job, good job.
Thank you, gentlemen.
Appreciate it.
Appreciate you.
Is there anything else to come before the meeting?
I have no new business.
All right, then let's adjourn this. This meeting is adjourned. Gotcha.
Bam, you're done.